Everyone is skeptical about Amazon. If you look at the chart, the company looks broken. In the last 2 weeks, this stock has been under strong pressure. It has lost almost 19% of its value, while the S&P 500 did not move at all. The massive sell-off started when Amazon announced that it will spend $200 billion in the AI race. Investors are looking at the headlines and they are scared. They see reports of massive spending. They see Andy Jassy committing billions of dollars to new data centers. And the narrative on Wall Street is starting to turn negative. They are saying Amazon is a low margin business that is spending too much money. I completely disagree. I believe the market is making a massive mistake. They are looking at the expenses, but they are ignoring the empire that is being built. In this video, I want to illustrate why I believe the current narrative about Amazon is wrong. First, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio over time, and sharing my thinking. My goal is simple: find elite businesses, buy them when others are fearful, and hold them for the long run. And right now, the fear around Amazon is creating an interesting opportunity. I will explain why I believe the stock is undervalued using my 4-pillar framework, the rebuild check. But before diving into the pillars, we need to understand why so many investors are skeptical about Amazon right now. For years, Amazon was seen as two businesses in one: a low-margin e-commerce machine and AWS, the highly profitable cloud engine that funded everything else. But in 2026, the narrative changed. During the latest earnings call, Amazon unveiled a $200 billion spending plan, significantly higher than the $131 billion spent in 2025. And this came at a time when companies like Meta and Google were also announcing massive AI investment plans, so the market was already on edge. Investors are now terrified of this new CapEx intensity environment. Wall Street sees billions being poured into AI chips and energy infrastructure and assumes margins will be crushed for years, but they are missing the bigger picture. This is not reckless spending. It is strategic positioning. We are entering the AI era, and AI requires enormous computing power. Who owns that infrastructure? AWS. By building these data centers today, Amazon is positioning itself to collect rent from every AI startup, bank, enterprise, and government agency for the next decade. They are not burning cash. They are building the digital railroad of the 21st century. And while the market focuses on the cost of construction, I am focused on the toll fees that will follow. Now, let's look at the actual numbers to see whether the business can truly support this level of spending. It's time for the rebuild check. Pillar number 1, the business quality. The question here is simple. Does Amazon have a moat? I would argue they have the widest moat on earth. Remember the boring e-commerce business model I mentioned earlier? In order to build that empire, they needed to become the best logistics company in the world. And as of today, they have a logistics network that no one can replicate. Not Walmart, not Temu. Nobody can deliver packages faster and cheaper in the US. This logistics network is the ultimate barrier to entry. It took Amazon 20 years and hundreds of billions to build. No startup can copy that, but the real quality of the business is AWS. AWS is not just a cloud provider, it is the operating system for the internet. It still controls over 30% of the global cloud market. But more importantly, look at the margins. AWS generates operating margins of over 35%. This is the cash machine that funds the entire empire. And let's not forget the hidden gem: advertising. Amazon is now the third largest ad platform in the world, generating over $50 billion a year. So you have the physical moat of logistics protecting the retail side, and the high margin moat of AWS and advertising driving the profits. This is not just a good business, it is a utility. Pillar 1 is definitely approved. Pillar number 2, the growth engine. Is this giant still growing? The answer is yes, and it is growing at double digits. From 2022 to 2025, Amazon was able to grow revenues at a rate higher than 11% each year. It might be easy growing revenues by 10% when you have a couple of millions in sales. However, growing at this rate when you have $500 billion in revenue is another story, and Amazon is doing it consistently. As you can see on the Q4 presentation slide, in 2025, we saw AWS growth re-accelerate because of AI demand. Companies are not just storing data anymore, they are training models, and that uses more cloud consumption. This trend will likely continue in 2026. Moreover, the retail side of the business is also growing faster than inflation. Wall Street expects revenue to grow at roughly 11% this year. For a company of this size, that is incredible. As long as companies continue to invest in AI and train their models, AWS will continue to grow, and this will ensure that the growth engine of the company remains intact. As a result, Pillar 2, the growth engine, also passes. Pillar number 3, the financial fortress. This is where we look at the balance sheet to determine a critical point. Can Amazon afford the AI bill? Amazon has over $123 billion in cash and short-term investments. This massive cash reserve gives Amazon the flexibility to pay for a good part of its investment plans in cash. On the liability side, they have $73 billion in long-term debt, which will surely increase due to the AI spending. However, the picture becomes more interesting when we look at the cash flow the company is capable of generating. The operating cash flow of the company increased significantly in the last couple of years. It went from $85 billion in 2023 to $140 billion in 2025. However, this increase was matched by a strong decrease in investing cash flow, which jumped to minus $142 billion in 2025. During the same years, the free cash flow of the company decreased from almost $32 billion to just $8 billion in 2025. Do you know why it decreased? Because they have already started the massive spending cycle on AI infrastructure. The CapEx bill is eating into the cash flow temporarily. While most people will focus on the decrease in free cash flow, it is crucial to realize that in 2025, Amazon was able to finance the increased CapEx expenditure through its massive operating cash flow. Even with this historic spending, they are financially secure. That is the definition of a fortress. So Pillar 3, financial fortress, also passes. Pillar number 4, the valuation. This is where it gets interesting. Amazon has historically traded at very high multiples. The PE ratio was often over 30 and sometimes much higher due to inconsistent earnings. But right now, it is trading around 28 and the forward PE is around 26. These figures seem much more reasonable. Now, 30 might sound high if you compare it to a bank. However, compare that to the rest of the tech sector, which trades at an average PE of over 31. Amazon is actually cheaper than the sector average. Actually, if you strip out the massive investments they are making, the underlying profitability is even higher. So, is it a steal? Maybe not. But is it a fair price for a monopoly that dominates cloud, e-commerce, and advertising? Probably yes. Given these circumstances, Pillar 4, the valuation, also passes. Amazon passes the rebuild finance check with flying colors. The market is selling because they are scared of the short-term CapEx spending. I am keeping my shares because I love the long-term infrastructure dominance. I believe that in 5 years, we will look back at this AI spending cycle as a moment Amazon secured its future. In the next months, I will be slowly adding to my position, and I plan to hold these shares forever. But what about you? Are you worried about the billions they are spending, or do you trust the management? Let me know in the comments. If you found this breakdown helpful, please hit that like button. Please write also a comment and tell me which company should I cover next. If you want to follow my journey building a portfolio to 1 million, make sure you subscribe. And if you are curious about what is happening and why the major software companies are selling off, make sure to watch this video right here. Thanks for watching, and I will see you in the next one.